Good afternoon. My name is Lyman King. I am one of your corporate operations trainers here in the Austin branch, and I am here today to discuss with you about credit scores and mortgage loans and how they very specifically affect our borrowers. Now, this class is a little bit different than a basic credit report class or a credit scoring class because we're going to tie it into and give some very specific instruction and examples on what your borrowers will be affected or how they will be affected by very specific credit scores. So what are we going to talk about today? Well, let's talk about that. The first thing we're going to cover is what information is in your credit report. In other words, let's know how to read it. We're going to talk about how credit scores can help you, and not just with mortgage lending, but with all walks of life. We're going to get very, very detailed on how a FICO score breaks down, and we're going to give very specific examples of how you can improve a credit score, and we're going to give you pictures that you can actually show your borrower. Again, we're going to show you then how to improve your credit score. And lastly, we're going to tie it all together with some common problems with getting a home loan in today's market, and then how that ties in with credit reports, their scores, and how to fix them. So we're going to pretty much cover the gamut today, but our prepared remarks are only going to take about 30 minutes, and then we'll open it up for Q&A. So what is in a credit report? Most folks feel that it is just, oh, here you go, do I pay my bills or not? But the type of tri-merge reports that we get in the mortgage industry covers a lot more. We, of course, have identifying information. It's got their name, their address, their social security, their date of birth, etc. And it has your trade lines, which is your individual creditors and how they report. But it also shows inquiries, voluntary and involuntary. Now, we're going to take just a minute here to talk a little bit about inquiries because this is one of the great myths that are out there in the marketplace today. There is a difference between the so-called hard pull and soft pull. Voluntary versus involuntary. They mean the same thing. As a voluntary hard pull inquiry is when you go to a creditor and say, I want some money. So if you apply for a home loan, if you apply for a car, a credit card, etc. An involuntary or a soft pull happens when not you specifically are targeted. So for instance, Citibank wants to go solicit a bunch of Visa card people. They will give a list of criteria to one or more of the credit bureaus. They'll say, I want this geographic area, I want this minimum credit score, I want these minimum trade lines, I want these many open revolving accounts. They can make that target list very, very specific. And so what happens then is the Bureau will run a report of everybody that meets that criteria, and they will generate that list, and they will give that list to the bank or whatever vendor is looking. They will now have your credit information, but that does not count as an inquiry. And so a lot of folks out there in the world get real concerned when they're getting all this stuff in the mail that all these different banks are running credit reports on them. They are not. They are merely creating a soft pull for marketing purposes, and that does not count against their score. So if you can talk to a customer and talk about hard pulls and soft pulls, you're going to impress them with your knowledge. Also in the credit report, as you might expect, are any type of public records and collection items, foreclosures, bankruptcies, liens, judgments, etc. So in the bigger picture, why are credit scores so important? Well, you need to understand the reason and the definition of what a credit score is. Why do they have credit scores? What is the purpose? There is a very specific purpose, and it's amazing how many people cannot define what it is. It is to predict the likelihood that a consumer will go 90 days delinquent on a debt. That's it. To predict the likelihood that a consumer will go 90 days delinquent on a debt. So when you start seeing people with delinquent student loans and they are out there with 2 and 3 lates on a 90-day basis, that's like worst case scenario for software. When you see a collection account, even a $25 or $50 collection account, but by definition, a collection account is typically 90 days delinquent or more before it becomes a collection account. So even though it's a little tiny dollar figure, the fact that it's a collection account is what's dinging the score. So what is it that impacts your credit score? Now, there's lots of stories out there about this does this and that does that. Well, what are the exact numbers? This information actually is fairly exact. There are 2 things that impact your credit score. The specific event that gets reported and the time that it has been on your report. The event and the time. Those 2 combinations are applied to every single operation of the software. As it goes through its analytics, it is not just looking at the event, but it is looking at how recent or how old the event took place. And we'll talk about that over and over again today because it's extremely critical that the consumer understands that time is just as important as whatever the specific event was. So how do your scores break down? Well, here it is. A picture's worth 1,000 words. Most people think that their credit score is made up of simply, do I pay my bills on time? And yet, we've all had customers with 5- and 10-page credit reports that don't have a single late payment, and their credit score is 622 because they've got 6 credit cards that are all maxed out. So here is a chart that you can actually show your customer. The payment history. Do I pay my bills on time? Late payments, collections, credit cards, bankruptcies, all of the stuff in there as far as your payment history. Of course that's the biggest predictor. It's 35% of your score. But 30% of your score is the amount you owe on your credit cards or other revolving debt. The key is that it's revolving debt. So if you're somebody that doesn't believe in credit cards, and you've got a couple of old paid off student loans or car payments, you got a current car payment, and you've never had a late payment, you think you're going to have a 750 score? No, because in the absence of a payment history on revolving debt, your score will be knocked down considerably because there's no track record for the software to look at and analyze. 15% is the length of your credit history, the so-called thin files that we all talk about and you hear underwriters refer to. Then 10% is new credit. This is your whole inquiry question. And then another 10% is the types of credit used. Now we're going to break this down a little bit, but this is the chart where a picture's worth 1,000 words. So your payment history. This is 35% of your score. So, of course, the first thing that any lender, ourselves, a car guy, a Visa guy, JCPenney's, the first thing that they all want to know is, do you pay your bills on time? And of course, it's the most important factor. But it's not the only factor. So if you've got a few late payments, it is not a deal killer. Now, if it's a 60-day late versus a 30-day late, it hurts you more. If it's a 90-day late versus a 60-day late, it hurts you a lot more. And then remember time. A debt in the last 24 months hurts you a lot worse than a debt 3 or 4 years ago. A debt that was late 5 or 6 years ago doesn't hurt you as bad as it did 22 months ago. Remember the time factor. An overall good credit picture can outweigh 1 or 2 instances of a late credit card payment. However, if you have no late pays on your credit report, it does not mean you have a perfect score. You may not even have a real high score. Your payment history is just one piece that's used in calculating your credit score. 35% of it, in fact. So, public records and collections, extremely important to be considered in this. They're very serious. But again, time heals all wounds. So if you've got a collection account that's 5 years old versus 18 months old, are they scored differently? Yes, they are. Now, the other extremely Armageddon type influences on your credit score: bankruptcies, foreclosures, lawsuits, attachments, liens, collections, charge-offs, P&L losses. You'll sometimes see that old code still hang around. Judgments. All of these, by definition, are older than 90 days, so they represent Armageddon to the software. Now, 30% is the amount owed on your accounts. And again, I cannot emphasize this enough. This is revolving accounts. Revolving. Owing money on credit accounts doesn't necessarily mean you're a high-risk borrower, but the software reads that if you have most of your available credit used, you could be overextended. If you're overextended, you could miss payments. And in fact, if you've got all of your credit cards maxed out, the software actually factors in the possibility, the probability of a bankruptcy filing. So your FICO score takes into account several of these factors. The amount owed on all accounts. So if you've got 5 Visa cards, each of them with a $5,000 limit, and you say, oh, but I only owe 50% on each of them. That's not bad. But one of the ways that it analyzes it is it'll look at the fact that you've got $25,000 of outstanding credit available and that you've used half of it. So the fact that you're spread across multiple credit cards is factored into the score. The total amount on different types of accounts. So your score will consider the amount you owe on a specific type, such as a credit card and installment loan. So we say that this 30% is only made up of revolving debt. However, it also looks at new installment debt. If you've got a brand new car loan in the first 2 or 3 months and it has not had a chance to analyze your payment history yet, there is a negative bias in your credit scoring, even on installment loans. However, far and away, the most important thing here is how much you owe versus what the high credit limit is on your credit cards. Whether you're showing an amount owed on certain types of accounts. In some cases, having a very small balance without missing a payment shows that you're managing your credit responsibly and is actually better than carrying no balance at all. They have what they call a utilization ratio. And what that means is a lot of folks will say, well, I'm going to go get a credit card and I'm going to throw it in the drawer and I'm never going to use it. And sure enough, 12 months go by, 18 months go by, and they've never used it. If you are one of those folks, you need to take that credit card out every 4 to 5 months, make a small purchase, go ahead and pay it off so there's no interest, and put it back in the drawer for another 4 or 5 months. But they look at the credit utilization ratio when they're scoring you in this 30 percentile category. It's extremely important. You can't just throw the credit card in the drawer and never use it. How many accounts have balances? We talked about this a minute ago. A larger number of accounts with amounts owed can indicate a higher risk of overextension. So sometimes folks will do some consolidation loans, and they'll take that $2,000 here and the $1,000 here and the $800 here, and they'll combine it all onto one credit card. And that credit card is all maxed out now, but all of the other ones are paid down to maybe $100 or $150. Is that better than being at a 50 to 70% utilization ratio on all the credit cards? As a general statement, yes, it is. How much of the total credit line is being used? Someone who's close to maxing out several credit cards has a high utilization ratio, and the software reads that as trouble. We've kind of beat this to death, but I cannot emphasize it enough. So, 15% is your length of credit history. And in general, kind of some common sense here, the more credit you have and the longer, remember that word time, the longer that you have that credit, you're going to score better. Now, we've all seen the stories of, the college kid comes out and they've got a $500 Visa and maybe they've got a $300 Macy's card, and both the credit cards are a year or two old, and they've got a 720 score. And you go, come on. They can't have a 720 score with just two little credit cards. Well, they can. Now, it isn't a 740 score or a 760 score or a 780 score. And also, because that credit file is so thin, if they were to get a ding, just a simple 30-day late on one of those two creditors, it's going to have a much bigger impact against their score because there's so few credit for the software to read and analyze. So it's not that hard to get a 7 to 720 score and have thin credit as long as your credit paying history is perfect, and of course you have not very much usage on those credit cards. But if those two credit cards are maxed out, you're going to see a 640 instead of a 720 because there's no depth of the file. And there's really there's nothing that you can do about that with your borrower. They have what they have. Your FICO score takes into account how long your credit accounts have been established. The age of the oldest account is always referenced on your credit report. How long specific credit accounts have been established? How long has it been since you've used certain accounts? That's what we talked about a few minutes ago. You can't just throw them away in the drawer anymore. 10% of your score is your credit mix. The FICO score will consider your mix of credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Now, it's not necessary that you have all of those, but the better the mix, the better the score. One of the things we've seen in the past is there's folks out there who don't like credit, and they'll only go get it when they absolutely need it, and so they use places like cash calls and the old Beneficial Finance and Transamerica and Household and a lot of these hard money consumer lenders. And the FICO score reads the different types of vendor. If you've got a car payment going to Santander or a car payment going to Wells Fargo Bank, are they scored the same? Yes, they probably are. But if you have multiple loans going to finance companies, high-risk consumer loans, as opposed to more standardized credit union or bank loans, that will start weighing against your score. Now, the credit mix isn't usually a key factor in determining your overall FICO. Remember, it's only 10% of the potential score. But if you don't have a lot of other information for it to base itself on, it becomes more and more important. Back to those skinny file people again. Okay? Have credit cards, but manage them responsibly. People with no credit cards tend to be viewed as a higher risk than people who have managed credit cards responsibly. Just cannot say it enough times. The last piece that we look at for your score is new credit. And here comes the heathen word, inquiries. Research shows that opening several new credit accounts in a short period of time represents a greater risk, and the FICO score factors that in. It's okay to request and check your own credit report. Checking your credit report won't affect your FICO score as long as you order your credit directly from the credit reporting agency or through an organization authorized to do that, such as MyFICO. And while we're talking about MyFICO, if you would like more in-depth information than what we're talking about today, obviously in 30 to 45 minutes we're just scratching the surface. If you would like more information, probably the best place I can send you is myfico.com. And yes, it is a website published by the FICO company, Fair Isaacs. They're located over in the Bay Area, and they are the ones that design the software that's used by, I think, millions of vendors and banks across the world. And they have a very good website for reference. Don't hesitate whatsoever to send your borrower there if your borrower is having a hard time understanding or believing what you're telling them. Send them to myfico.com. Tell them it's maintained by the same people who created the FICO scores, and they've got to believe you then. Don't open new accounts too rapidly. If you've been managing your credit for a shorter period of time, again, thin file people, don't open a lot of new accounts too fast. The new accounts are going to lower your score because it lowers the account age. And if you don't have a lot of other trade lines, it will have a bigger impact. We see it every day. Remember that debt consolidation scenario I gave you a few minutes ago? Well, if you go get a brand new credit card with a $10,000 limit, and you take all of your other credit cards and other debt, and you combine it into that one creditor, that one $10,000 line of credit. The problem is, not only is that credit line maxed out, but it is a new inquiry, and it is a new creditor. So here's a creditor that's 1 or 2 or 3 months old and is maxed out. So when we talked about debt consolidation a few minutes ago, and I said generally it's a good idea and it will help your scoring, be very, very careful to acknowledge that if you do that with a brand new account, there may be more harm than good. Again, it's a brand new line of credit that you've maxed out. That's not good. So how many recent inquiries you have does have an impact. Now, an inquiry is when a hard pull or a direct lender makes a request for your credit report or credit score. Now, your inquiries remain on your credit report for 2 years, but the FICO score only factors it in for the last 12 months. And oh, by the way, when you feed your file into DU, how long does DU analyze? 6 months. So the FICO score uses 12 months, but DU looks at their overall analysis at inquiries in the last 6 months. Little piece of trivia there for you. Now, credit scores, FICO in particular, is carefully designed to count only those inquiries that truly impact your credit risk, because not all inquiries are. There's 3 important facts to note. First of all, even if you have several inquiries, they usually have a small impact. I mean, we're talking about, by definition, if you absolutely go bananas and mess up and have 47 inquiries in the last 2 or 3 months, it only impacts 10% of your score. So if you manage your credit properly and you don't have any late payments and you had a 740 score, how bad can you hurt it because of inquiries? Well, not so bad that you're not going to get a loan like some people fear. Many types of inquiries are ignored completely. What do I mean by that? Well, part of the rules that the Federal Trade Commission has, who, by the way, is the federal watchdog for all things to do with credit bureaus and collection agencies, they have a rule that basically says you can have an unlimited amount of the same type of inquiry within a 14-day period of time, and it's not supposed to hurt your score. So as a loan originator, I used to tell people, oh, God, don't ever go to lendingtree.com or any of those guys because they sell you out and you've got 5, 6, 7 guys all banging your credit. And people go, oh, yeah, I see what you mean. And well, to be honest with you, I may not have been giving them accurate information. The FICO score as they tell us, now we may or may not believe them, but as they tell us, that will only count as one inquiry. Even though there were 10 different auto loans, 10 different dealers that you went to on the same weekend, supposedly it's only supposed to count as one inquiry. Now, I have to tell you that my personal experiences, I'm not so sure I believe that. I have seen people whose scores have taken a 25-point hit. When they come back in 3-4 months later, we have to update their credit report. They went out and bought a car. There's 15 inquiries on there, but everything else is about the same. And their credit score took a 25-point hit. FICO says that won't happen. Federal government says it's not supposed to happen. Lyman says, I'm not so sure. So take that with a grain of salt. You depend upon your own experience and your customer's experience to guide you there. But theoretically, your score will always allow for rate shopping as long as it's done in a short, condensed period of time. One of the biggest myths that you will need to overcome as a loan originator is that my credit score will drop if you run my credit report. They went and saw somebody else with a different realtor 3 weeks ago and got pre-approved or pre-qualified, and they don't want you to run the credit again. Well, I guess all I can say is it isn't true. And based upon the information from the last 2, 3, 4 minutes, I'm hoping you can convey to the customer that it isn't true. And if, in fact, they want you to do the loan or you want to be in running for the loan, you need to work hard to get them to allow you to run their credit. Because you will explain that as a direct lender buying new construction, that credit report's good for 120 days. You won't need to repull it again. They go talk to somebody else, it might have to get pulled 2 or 3 more times, even if they stay with that guy. And heaven forbid if it's a broker. Okay? So this is a sales opportunity, because if they are that concerned about inquiries, then once they let you pull their credit report, they will be more resistive to have lender number 3 or number 4 or number 5. So turn this myth around. Be the myth buster, yet use it to build a little bit more commitment from the borrower. So here's some tips to fix and maintain good credit scores. Yeah, pay your bills on time. Get current and stay current. Be aware that paying off a collection account will not remove it from your credit report. And here, folks, is myth number 2. If I pay off a collection account, my credit score will improve. The truth of the matter is, almost always when you go pay off a collection account, your credit score will go down. Because remember what we talked about early on. It's a specific event and time. So what's happened now is they get turned into collection 4 years ago. It's a $200-300 medical bill, Visa. It doesn't matter. It's a collection account. It's 3 to 4 years old. The older that account reads as being a collection, not whether it has a zero balance or not, that isn't what the score is looking for. The software is looking for the specific event, collection, and time, 3 to 4 years ago. So now they run in today. They pay that account to 0. The creditor updates the date of last activity to last week. Now you run the credit report, and the FICO reads collection account, just like it did before. Time, it reads last month, because it reads the date of last activity. And when the creditor reports a zero balance, they update the date of the zero balance, which will lower your credit score, because the software doesn't care about the balance, it cares about how old the collection is. And the only way you get around that is to have that collection account deleted. I don't care who tells you anything else. The date of the collection account is critical as opposed to the balance. And the only way you can have a collection account not hurt your score is if it is completely deleted, not paid to 0. If you're having trouble making ends meet, contact your creditor or see a credit counselor. Not advising you to go to a consumer credit counseling service. Not telling you to go into that, but I will tell you a lot of people that do come out of it a lot better than if they wouldn't. They save money, they get back on track, and as a general rule, the creditors stop reporting you as delinquent once you get into a formal payment plan. Keep your balances low on credit cards and other revolving credit. Pay off your debt rather than moving it around. Don't close unused credit cards as a short-term strategy to raise your score. Myth number 3. We've talked about this a lot. It is your total available credit of all your credit cards combined versus the amount of that credit you've actually used. And if you've got a $5,000 limit Visa card sitting in the drawer and you haven't used it for a year, and you think, oh, if I go close that account since I haven't used it, it'll help my score. It will not. And in fact, it could lower your score because now you've taken $5,000 of available credit off the board when the software calculates that utilization ratio. I hope that makes sense. Don't go open a number of new credit cards that you don't need just to increase your available credit. Because for the first several months after doing that, it's going to negatively impact your credit. Now, if somebody's got a 1 or 2 year plan, and they're going to go out and they're going to get 2, 3, 4, 5 pieces of revolving all this month and next month because they're not going to buy a house for a year, and they want those credit cards now and to start aging, remember, time, then that is actually a tremendous strategy as long as they don't need any new debt or any new vendor in the next 12 months or so. It's all about planning. If you've only been managing your credit for a short time, don't open the accounts too rapidly. If you're going to shop for a rate, do it within a very short period of time. And please tell people, myth number 4, they have bad credit, they file bankruptcy, they have a foreclosure. People stick their head into the sand, they pull the turtle shell over the top, and they don't come out because they're afraid of getting new credit or they're afraid no one will give them new credit. Well, if they don't get reestablished, they're not going to improve their credit score. Apply for and open new credit accounts only as needed. Have credit cards. Don't let people be afraid of credit cards, but just learn to manage them responsibly. Does that make sense? So this is all advice that loan originators can give to their borrowers. It also makes a very good handout when you interview people who are credit challenged. It's one more piece of paper you can put in their hand. Now, we've all seen what happens to lower credit scores and lower down payments when you're trying to do a conventional loan. But have you ever seen the whole grid? I mean, we see the matrix sitting on our price sheets, but here's the whole picture. And again, a picture's worth 1,000 words. As a loan originator, I had this document printed in a flyer format, really nice looking, logos and pictures and all that stuff. But I had this beautiful one-page flyer, and I handed this thing out like candy. I gave this flyer out more than any other flyer that I did. I gave it to realtors because the first thing you do in a 5% market, when you quote your borrower 5.5, the realtor's going to go, oh my God, that's a terrible rate. Let's go talk to somebody else. Well, that's because they don't understand that even though the guy's putting 20% down, he's got a 655 credit score, and it's a 3-point hit. If he had this chart, you can make a proactive phone call. And you can have a conversation with the realtor that says, yeah, Billy Bob's good to go, and he can buy up to $200,000, and I would write that puppy at about 20% down up to $200,000. I've got all that verified. But with his credit score, he's going to have a higher rate, and you need to understand that. Now, perhaps the borrower is given permission that you can discuss this openly with the realtor. Perhaps he hasn't. So you need to be conscious of that, and you need to not say too much if you're not supposed to. But don't let the borrower go back to his realtor scratching his head going, yeah, gosh, Billy Bob's charging me a 0.5 point higher than somebody else that I read in the paper. It's because the paper was quoting a 740 credit score, and your guy's trucking along at 655. So use this price grid. Use it as a sales tool. Use it to overcome objections. So lastly, let's talk about credit issues and how they very specifically affect home loans. And there's two main ones, other than, of course, the raw score itself. The first is disputed accounts. How many hoops have we all had to jump through because of disputed accounts? Oy vey. The law generally requires, now I have to say generally, because again, is Fannie the same as Freddie, is the same as VA, is the same as RD, is the same as a private investor? No. Are all lenders exactly the same? No. Do some lenders have overlays that others don't? Yes. So please understand, I'm trying to give you general guidelines here. But those guidelines will generally require an item on a credit report if it's in dispute. That trade line cannot be calculated into the credit score. So if a borrower applies for a home loan and there are disputes present, then a true credit score reflecting that borrower's paying payments may not be presented. And I apologize, I stated that wrong. It is federal law that dictates if there is an ongoing dispute on the credit report, whatever that is cannot be calculated into the score. So this is why, as a general rule, there is a policy out there in the mortgage world that says if you have a disputed account, here are your policies and procedures. And most of those policies involve either a manual downgrade in underwriting, which causes a lot of issues, or it's a requirement that you have to get it completely deleted from their credit report as a dispute. And again, why? It's because by law, that dispute is artificially impacting the credit score. And we've all seen examples where somebody has a 700 credit score and they get one $50 collection and it knocks them down to a 625 credit score. It literally costs them 70, 75, 80 points. Well, on that Fannie Mae pricing grid we just looked at, you're talking thousands of dollars. So a strategy has been on the part of borrowers, realtors, and credit counselors, hey, wait till you're ready to buy a house. We'll go dispute that one item, and you'll be back to that 700 score, even though you really owe the money. So that's the thought process behind investors and agencies making such a big deal the last 2 to 3 years out of disputed accounts. Another big issue is authorized users on your subject credit report. When a credit account owner permits another person, it's typically a family member who's got a real thin file and they're trying to help them build credit, they give them access to and able to use an account. That user is referred to as an authorized user. This practice is intended to assist people legitimately in helping getting their credit established. Even though that person's not the owner of the account, even though that person's not responsible for a payment. Now, similar to disputed accounts, generally speaking, agencies and investors will all have a little different opinion on how to handle authorized users. But it is a general practice or guideline to require that trade line to be removed from the report, and then the report gets repulled. So I have actually, as an originator, lost one loan in my career where we had a disputed account. The underwriter really didn't think it would impact the score that much. So she went ahead and approved the file, made it a prior to doc condition that we get that dispute off of there. When we did, not dispute, authorized user. And when we did, it turned out that was the deepest credit trade line that customer had. And they went from like a 712 down to like a 610 with one authorized user account being removed. Because it was the main trade line. And when it went away, FICO had nothing positive to draw from. They had an old 3-4-year-old paid as agreed account and an open collection account, and that was about it. There was just 2 or 3 things on there. And so now all of a sudden the weight of that old collection account became a lot more important than that payment history that was getting included. And we literally lost the loan. We couldn't fix it. So authorized users, very, very important. Questions. At this point, we're going to open it up for questions. Da, 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 da. Okay, we're done with questions. So, again, my name is Lyman King, and we're brought to you by the National Training Department here with DHI Mortgage. We're here in Austin. We're an email away. Please, at any time, on any topic, not just today's, but if there's something we can do to help you with your production, give us an email at Mortgage Training Department at dhimortgage.com. We've got an inbox. We monitor it all day long, and we're happy to answer your questions. Thank you so much today. If you have any feedback, please give it to us. Have a wonderful day.